Listen to me very carefully. What just happened at the COMEX is not normal. This is not another technical adjustment. This is not routine market maintenance. The largest precious metals exchange in the Western world just triggered an emergency threshold that has not been activated in over 4 decades. And the number attached to this alert, $250 per ounce of silver, should make every serious investor stop and pay attention. But here's what's really happening behind that headline. The delivery system is breaking, not bending, breaking. And when the delivery system breaks in a commodity market, everything changes. Let me explain what the COMEX actually is, because if you're over 40, you probably remember when markets were simpler. You bought something, you owned it. You sold something, you delivered it. The COMEX changed that game. It's the commodity exchange, the place where precious metals futures are traded. It's where prices are discovered, where hedgers meet speculators, where paper promises trade at volumes that dwarf the actual physical metal that exists. And for decades, that system worked. Until now. Here's what triggered this alert. The COMEX tracks something called the delivery ratio. That's the relationship between the amount of silver that could be demanded for delivery versus the amount of silver actually sitting in their vaults ready to be delivered. Think of it like a bank. As long as only a small percentage of depositors want their cash at any given time, the bank functions fine. But the moment too many people show up demanding their money, the system freezes. We call that a bank run. What's happening at the COMEX right now is the early stages of a metal run. The threshold they just triggered indicates that delivery requests are approaching levels that their current inventory cannot support if the trend continues. This isn't speculation. This is mathematics. They have X amount of silver in their vaults. They have Y amount of paper contracts that could demand delivery. And for the first time in modern history, Y is getting too close to X. When that happens, when the exchange itself acknowledges that the paper game might not be sustainable, that's when smart money pays attention. Now, why $250? That number isn't random. It's not designed to grab headlines. That's the exchange's internal calculation of where silver prices would need to trade to rebalance supply and demand if delivery pressure continues at current rates. Let me say that again in plain English. The people who run the largest silver exchange in the world are telling you that silver needs to more than triple from current levels just to prevent a delivery crisis, not to create a bubble, not to fuel speculation, to prevent a crisis. You've been around long enough to recognize when institutions are trying to tell you something without causing panic. This is one of those moments. They're not holding a press conference. They're not calling emergency meetings with the media. They're issuing technical alerts that most people will ignore or misunderstand. But the message is clear if you know how to read it. The system is under stress. The old equilibrium is breaking. And prices need to adjust dramatically to restore balance. Let's talk about what delivery pressure actually means. When someone holds a silver futures contract, they have 2 choices at expiration. They can roll the contract forward to a future month and stay in the paper game, or they can stand for delivery and demand the actual physical metal. For years, 99% of contracts got rolled forward. That's how the system functioned. That's how exchanges could have 100 paper claims for every ounce of actual metal. Nobody actually wanted the metal. They just wanted the price exposure. That dynamic is changing. More contracts are standing for delivery. More traders are saying, we don't want to roll forward. We want the metal. And this isn't just small speculators. This is industrial users who need silver for manufacturing. This is large investors who've lost faith in paper claims. This is foreign entities who want metal out of the US system entirely. Every month, more people are demanding delivery. Every month, the vaults have less metal to give them. Every month, the ratio gets worse. The COMEX knows exactly how this ends if the trend continues. They've seen it before in other commodities. They've studied the history of market corners and delivery squeezes. They know that once delivery pressure reaches a critical threshold, prices don't move gradually. They spike violently. Because the people who are short those contracts, who promise to deliver metal they don't have, they need to buy that metal from somewhere. And when everyone is trying to buy at the same time and there's not enough to go around, price becomes irrelevant. You pay whatever it takes. That's what $250 silver represents. That's not a bull market price target. That's a crisis price. That's the level where shorts capitulate, where industrial users panic, where anyone who needs physical metal stops caring about cost and starts caring only about availability. And the COMEX is telling you right now that this scenario isn't just possible, it's probable if current trends continue. Now let me explain why this matters to you specifically as someone who's built wealth over decades. You've probably never thought much about commodity delivery mechanics. Why would you? You owned stocks, they sat in your brokerage account. You owned bonds, you got your interest payments. You owned real estate, you had the deed. Everything worked the way it was supposed to. But commodity markets are different. They're built on leverage. They're built on the assumption that physical delivery is rare. They're built on trust that the paper claims are as good as the metal itself. What happens when that trust breaks? What happens when people start demanding the actual commodity instead of accepting the paper promise? The entire pricing mechanism breaks down, because suddenly the exchange has to admit that all those contracts they sold don't have metal backing them. They have to admit that the price discovery mechanism was based on a fiction. And when that fiction gets exposed, the repricing is brutal. You remember 2008. You remember what happened when people realized that mortgage-backed securities weren't actually backed by performing mortgages. You remember how fast those markets collapsed once the fiction was exposed. This is similar except in reverse. Instead of paper assets going to zero, the physical asset spikes to prices that seem impossible because suddenly everyone realizes there's not enough to go around. The COMEX vault inventories right now are at levels that should concern anyone who understands these markets. They're not at zero, but they're declining. Consistently. Systematically. Month after month, more silver leaves the vaults than enters. Month after month, the buffer between paper claims and physical metal shrinks, and the exchange can see where this is heading. That's why they triggered the alert. Here's what makes this situation particularly dangerous. Silver isn't just an investment metal. It's an industrial metal. Solar panels need it. Electronics need it. Medical devices need it. 5G infrastructure needs it. These aren't optional luxury uses. These are critical applications for modern technology and infrastructure. So you've got industrial users who will pay whatever it takes to secure supply, competing with investors who are starting to doubt paper claims. That's a collision course. And unlike gold, where central banks hold massive reserves that could theoretically come to market, silver doesn't have that safety valve. Central banks don't stockpile silver. Governments don't hold strategic reserves. Once the available supply gets tight, there's no cavalry coming to save the market. The only resolution is price. Price has to rise high enough to either destroy demand or incentivize enough new supply. Given how long it takes to bring new mines online, we're talking years before supply can respond. The $250 threshold isn't just about silver. It's about what silver represents. It's an indicator of stress in the commodity system. It's a warning about the paper markets that we've all taken for granted. It's a signal that the assumptions underlying modern finance might not hold under pressure. When you can't deliver a physical commodity that's supposedly backing all these financial instruments, what else can't be delivered? What other promises won't be kept? Let's talk about the timeline because this matters for decision making. The COMEX alert doesn't mean silver goes to $250 tomorrow. It means that if current delivery trends continue, the exchange calculates that's where price needs to go to rebalance. How long does that take? Nobody knows. Could be months, could be years. But here's what history tells us. These transitions happen faster than anyone expects. The stress builds slowly, then releases violently. Think about your own experience with market dislocations. How long did it take for everything to fall apart in 2008 once the cracks started showing? How fast did the dot-com bubble burst once momentum reversed? How quickly did inflation spiral in the 1970s once it got started? Markets spend years building imbalances and weeks correcting them. And right now, the silver market is building an imbalance that the COMEX itself is warning about. What should a prudent investor over 40 do with this information? First, understand that this isn't about getting rich quick. This is about recognizing a structural shift in an important market. Second, recognize that you're getting advanced warning. The COMEX just told you what's coming. Most people will ignore it until it's too late. Third, consider whether your portfolio is positioned for a scenario where commodity prices spike due to delivery failures and supply shortages. You don't need to bet the farm on silver. You never need to bet the farm on anything. But you might want to ask yourself whether you have any exposure to this scenario. Because if the COMEX is right, if delivery pressure continues and prices need to reach $250 to clear the market, that has implications far beyond silver. It means commodity markets are broken. It means paper claims are unreliable. It means physical assets matter more than financial promises. Here's the mathematics that should interest you. Silver is currently in the low 70s. The COMEX is indicating it needs to reach 250. That's a 247% move. Not 10%, not 20%, 247%. Now, what's the downside risk? Could silver go to 50, to 40? Maybe. But at those levels, industrial demand alone would absorb everything available. The physical bid under silver is much stronger than most people realize because it's actually used in critical applications. So you're looking at limited downside versus substantial upside. In the scenario, the exchange itself is describing. That's asymmetric risk reward. That's the kind of setup that mature investors should at least investigate. Not chase, not over-leverage. Investigate and potentially position appropriately for your situation. But here's what concerns me most about this alert. It's not just about silver prices, it's about market integrity. If the COMEX can't deliver on its contracts, if the paper market becomes untethered from physical reality, what does that mean for all the other markets we trust? What does it mean for your bond portfolio that's just promises to pay? What does it mean for your stock certificates that are just electronic entries? What does it mean for your bank account that's just a number on a screen? Physical silver is one of the few assets where you can actually hold the thing itself, where you can remove it from the financial system entirely, where you don't need to trust a bank, a broker, an exchange, or a government. You can have the metal in your possession. In a world where delivery systems are breaking, where paper claims are being questioned, where trust in institutions is declining, that tangible quality becomes valuable in ways that go beyond just price appreciation. The COMEX alert is telling you that the largest silver exchange in the Western world is worried about its ability to fulfill its core function, which is facilitating delivery of physical metal. Think about what that means. The institution whose entire purpose is to bridge paper and physical markets is saying the bridge is under stress. That's not a small thing. That's not routine. That's existential for the paper market. And here's where it gets really interesting. The exchange can change rules. They can raise margin requirements. They can limit position sizes. They can restrict delivery. They've done all of these things before in other markets under stress. But all of those interventions do is delay the inevitable. They don't create new silver. They don't make industrial demand disappear. They don't eliminate the fundamental imbalance. They just push the crisis down the road while making it worse. When markets reach the point where exchanges have to intervene to prevent delivery, that's when smart money recognizes the end game is near, because those interventions don't last forever. Eventually, the market forces its way through whatever artificial constraints are placed on it. And when that happens, the price adjustment is spectacular. You're at a stage of life where preservation of wealth matters as much as growth. You can't afford to lose everything chasing some speculative mania. But you also can't afford to ignore warnings from the institutions that run the markets. The COMEX just gave you a warning. They attached a specific number. They explained the mechanism. They told you what's coming if trends continue. Most people will dismiss this. They'll say silver is too volatile. They'll say commodities are risky. They'll say they're comfortable with their current portfolio. And maybe they're right. Maybe everything will be fine. Maybe delivery pressure will ease. Maybe new supply will appear. Maybe industrial demand will collapse. Maybe all the stress signals are false alarms. But what if they're not? What if the COMEX is right? What if delivery pressure continues? What if $250 silver is where this market needs to go? Do you want to be the person who heard the warning and investigated? Or the person who heard the warning and ignored it? Here's what I'm seeing. An exchange triggering an emergency alert. A specific price threshold that's more than triple current levels. Vault inventories declining. Delivery requests rising. Industrial demand that's not going away. Supply that takes years to develop. And a paper market that's starting to lose credibility. Those aren't opinions. Those are observable facts. What you do with those facts is your decision. But years from now, when silver is trading at prices that seem impossible today, when delivery failures are front page news, when commodity markets have undergone fundamental restructuring, you'll remember this moment. You'll remember the COMEX alert. You'll remember the $250 threshold. And you'll know whether you paid attention or looked away. The emergency alert has been triggered. The delivery crisis is building. The price threshold has been identified. The only question is whether you're positioned for what the exchange itself is telling you is coming. Not as speculation, not as prediction. As mathematical necessity, if current trends continue, the warning is there, the data is clear. What happens next is up to you.